Okay, we'll reconvene by calling on Makita, and then after Makita, we'll call on Ms. Yee.
Thank you. Steve McCourt with Makita Investment Group. To my left, Lisa Bacon. I will provide very few summary remarks on our annual program review, and Lisa will go through more of the details. We were just presenting last month to you the semi-annual performance review. So the performance of this portfolio, as you know, has been very, very strong. For the one-year period, the return was 20.6%, and for the trailing 10 years, 14.4%. So well beyond any benchmarks that have been set. We've communicated to Paul that that's barely good enough for us. So nice work, Paul. The net asset value and the size of the program continues to grow at a nice clip. During the last year, the net asset value increased from $3.8 billion to $4.3 billion, an increase of 14%. The program is in compliance with all key parameters related to various policies that govern the infrastructure program. The program is well staffed. The most significant policy change in the program over the last year relates to the target allocation to infrastructure, which through the end of the prior fiscal year was 1%. Going forward, infrastructure does not have a board-assigned target allocation. It now is a discretionary component of the real assets program. As Paul mentioned, staff is happy to provide detail on their thoughts of growing the program and evolving the program in the absence of that specific target under closed session. So with that, let me hand it over to Lisa for more of the details.
Thank you, Steve. Lisa Bacon, Makita Investment Group. So as Steve mentioned, since we were just here in August, and essentially the performance numbers that we covered then are the same as we have covered in our letter today, for our remarks here in the open session, I thought I would focus on some of the charts that we prepared for you to take a look at the historical evolution of the program so that we can get a better understanding of where the program is today and how it got there. And so I'll direct your attention first to page 3, Exhibit 1. And so the bar chart here on the left side of the chart shows the NAV, and then on the right side of the chart with the line going up, that shows you the percent of the total fund. And so just in looking at the picture, you can see from the period 07 to 13 that the program kind of got a bit of a slow start, increasing a little bit, but really there's sort of a demarcation when you start looking at 2014 moving on. In 2014, the program crossed $1 billion for the first time. In 2015, it crossed $2 billion. In 2017, it crossed $3 billion, and this year it crossed $4 billion. And so as Paul mentioned in his remarks, the program has made a lot of progress just in the last couple years. And so from 2014 to 2018, that is a doubling of the portfolio. And the thing that is also notable during that period of time is the total fund was growing also. And so to double your infrastructure portfolio, you had to more than double the actual exposure. Turning your attention to the next page on Exhibit 2 gives some background on where those exposures came from and how they came about. The bars here show the amount of commitments, and so not deployment, but just commitments either to funds or to accounts in terms of what a manager would have the authority to deploy. And each separate chunk of those bars is a different manager or a different account, and the height of the bars shows how much was committed. Similar to the last chart, there's two two different axes going on, and so the line here shows you the cumulative commitments over that period of time. And so similar to the chart that we just looked at, where there's a demarcation where there was a much steeper increase in the NAV, you can see around 2013 that the line of cumulative commitments starts to steepen appreciably, and currently you're sitting right now at about $5 billion in commitments. One of the things we see when we look at this is that the commitments are not as consistent as far as vintage years that you ordinarily would like to see, and the amounts of the commitments are not what are necessary to maintain a target exposure. I think over the current year and the year past, as staff has talked about and may talk about more, they have a number of initiatives that are going to position them better to have other vehicles and more commitments in place that will improve the vintage year profile. In terms of investment activity this year, which we did not remark on in August, we noted the Rocky Caney Wind investment, which is one of the largest investments. There were some smaller investments by existing managers that we noted occurred but didn't really profile them. And so this is in total a 349 megawatt asset with operations in Kansas and Oklahoma, and it makes a meaningful addition to the renewable infrastructure portfolio, moving that from 16 to 21%. In terms of managers, drawing your attention now to page 5 and the chart, this is, again, similar. We wanted to take a historical perspective of the different aspects of the programs, and so this chart shows the percentage of the total NAV over the period of years that are deployed through funds, separate accounts, or direct investment. And as the bars go across the period, you can see that the percent managed in funds decreases over that period of time, and the amount managed through direct investment and accounts increases over that period of time. And so today you're sitting at a total of 8 general partners. You've got 3 in direct, 2 in accounts, and 8 in the commingled funds, and that is consistent with the policy preferences in the strategic plan. And then finally, just to make a few comments on future portfolio evolution, as Steve mentioned, and as you all are well aware, the previous target for infrastructure, which was 1% underneath real estate but specified, is now embedded within real estate's 13% plus or minus 5. Staff has been working on some strategic planning and pacing planning, and as I mentioned and Paul had mentioned, working on a number of initiatives that will give them more capacity and a couple different kinds of vehicles. But in order to maintain the existing exposure, if that's desired, and even increase it, there are a number of things that are probably necessary to engage in, at least as much as the staff has already been doing, and perhaps a little bit more. We've mentioned a few of these here. These are obvious things that people have already been talking about in terms of more separate accounts, keeping with the direct targeting, possibly looking at some club investments where 3 or 4 like-minded, like-size investors get together essentially in a separate account of 3 or 4, which provides some advantages for scale and also diversification. Also looking very selectively at commingled funds. There may be some geographies or strategies where going with a commingled fund manager is really the best risk-adjusted return and provides the best access to deal markets. For example, if there were a desire to go into Africa more, that might be a geography where finding a manager that had been operating and investing there for 15, 20 years would be would be the way that you all would want to start out, at least. Also looking at some more co-investment opportunities. Those can come by themselves, but they also can come along with those commingled funds, and that's a nice way to get access to those. And then finally, looking perhaps a little bit more at value add and opportunistic. In the first chart that I showed you, there, the bars are colored to show the core and the value add and opportunistic, and as Paul mentioned, you can really see both the percent and the absolute amount that has been increased in the core space. By the same token, there are a lot of interesting strategies in the value add and opportunistic space that might be attractive with respect to access and also with respect to risk return profile. As Steve mentioned, with respect to the investment policy, as we mentioned in August, everything is compliant there. And I think that's probably the extent of our remarks for right now. Happy to take any questions.
Okay, thank you. Ms. Yee, would you push your button? Okay, Ms. Yee.
Thank you, Mr. Chairman. And this is really more of a kind of a question for future thought, but and I appreciate the response, Ted, earlier. But the question has to do with just fee transparency, which I think we want to see more of across the board. And my original question was whether there was greater fee transparency between infrastructure GPs and LPs than we typically see in our private equity funds, and understanding that there's a distinction between looking at tracking fees, whether we have separate accounts or commingling of funds. But I'm also just struck by the tools that we might have available to us to do a better job of that. And perhaps this is more appropriate when we talk about the PE model again, but particularly with Pillar 3, as we talk about getting into the technology space, about is there an opportunity to have some machine learning application that could actually enhance the that particular task of tracking fees. So maybe that's more appropriate. But I think as a, I don't know if Makita has any other thoughts to add to what Ted had identified as kind of a distinction here.
Thanks. I largely agree with Ted. The significant difference in transparency and fees doesn't really relate as much to private equity versus infrastructure. It relates to fund vehicle type, so funds versus separate accounts. Separate accounts generally provide you a lot more opportunity for both better transparency of fees, negotiation of fees, and reporting of those fees. One could argue that infrastructure assets in general are a little less complex than private equity assets, and so generally more simple assets lead for less opportunity for complex fee schedules, but the big transparency difference is going to be in the vehicle type.
Okay. Thank you.
Okay, thank you. Seeing no further questions, that completes that item. Now we will go to item 8A, review of investment policy update, an information item. Yeah.
So, to Mr. Chair.
First reading.
Yes, just the first reading. Kit Crocker will be presenting this for the investment staff.
Thank you. Kit.
Thank you. Kit Crocker, CalPERS staff. Item 8A is a first reading of staff's proposed updates to the total fund investment policy and the real assets program investment policy. Staff brings policy revisions before this committee at various points throughout the year. Just want to point that out for general context. While these are typically not ad hoc revisions, in fact, they follow a fairly set annual review cycle. For example, the more general updates to the total fund policy, which governs, as you know, over a dozen investment programs and functions, would typically arise during our annual, if you will, well baby checkup for the total fund, during which a broad range of staff from across the entire investment office review and identify any needed updates to the total fund umbrella investment policy. This annual checkup normally starts in the winter months internally, and if changes are needed, culminates in a presentation to this committee in the spring. I mention this mainly because that's not what we're bringing to you today. which I'll explain in a minute. The program policies are also reviewed annually in conjunction with their associated annual program reviews. And these program reviews typically start in August of each year and conclude in November or December, and we're in the midst of wrapping those up now. For this year's review cycle, staff from the Trust Level Portfolio Management, or TLPM, and Real Assets teams identified the required changes. And just so you know, the teams from Opportunistic Strategies, Global Equity, and Global Fixed Income also went through the exercise of reviewing and were involved, but have confirmed that no changes are indicated for their program areas at this time. So now turning to today's specific item. This is a first reading of the proposed changes arising out of the two recently concluded annual program reviews, namely TLPMs, which was concluded this past August, and the Real Assets Program Review, which is on the agenda, as you just heard, for this month. Now, while these changes are, in staff's view, relatively minor, we consider it important that the policies be as accurate and up-to-date as possible to reflect this committee's direction to staff. For the total fund policy changes today, they come in essentially three flavors. Changes related to recent organizational changes within the investment office, namely the transition of key analytical, monitoring, and reporting functions from the TLPM team to the IRP team, and updates to legacy content to reflect the latest and greatest. This includes items like changing the review window used to evaluate our realized tracking error, which, as you've noted, we're proposing that the policy reflect 5-year review or rolling evaluation rather than 3 years to reflect current practice. And finally, thirdly and finally, for several investment and operating responsibilities, we're proposing language updates just intended to better reflect our focus on holistic portfolio management versus individual asset classes in isolation. So then finally, we're also taking advantage of this opportunity, as we always do, to continue with our efforts to increase clarity and consistency within the policies. So, for example, changes in that category include the collapsing of duplicative statements into single concise items and minor phrasing changes to improve ease of reading. Regarding the Real Assets Program policy, you'll see we've explicitly called out the Real Assets Strategic Plan as a key consideration for staff's investment decision-making. For the net asset value thresholds the committee previously approved for the infrastructure and forest land portfolios, we've clarified that, as is the case for the geography and risk classifications, leverage limits will apply only when the portfolios reach a certain size to offset the comparatively lumpy nature of the infrastructure and forest land portfolios. So again, this is a first reading. We're seeking your feedback. And with that, I'll pause for any questions and also invite PCA, Makita, and Wilshire to comment.
Okay, Ms. Mather?
Yeah, I just have one question. And if I'm looking at attachment 4, page 7 of 8, under the leverage component, you've changed the language from limitations to parameters. So instead of reading leverage limits are imposed at both the program and portfolio level, you've eliminated that and changed it and now it says leverage parameters shall be measured on a loan-to-value ratio. But then in the next sentence, you added the permitted leverage limits are as follows. So I'm just a little confused about what's a limit, what's a parameter, why are we using that, two different terminologies? Do they have different meanings and intentions?
And I think the choice of the word parameter was intended to reflect that we have both maximums, the loan-to-value ratio is a maximum, whereas the debt service coverage ratio is a minimum. You raise a good point, though, then that final lead-in language, we go back to limits. I'd be happy to change that to parameters.
Okay, so what you really mean is parameters, and, okay, then that's
Yes.
fine. Yeah, if you change that to parameters, then that would solve the problem. Thank you.
Okay, seeing no further questions from the committee members, either Makiti, this is information item. There's no need to, yeah. Makita, Wilshire, have any comments?
Ali Kazemi from Wilshire Associates.
Okay.
Just wanted to comment that we did review the changes that staff had proposed and are supportive of those changes, as can be seen in our letter to the board. The one comment I'll make is in our initial review of the changes, some of the language that was changed was in regards to what the appropriate levels of risk and leverage levels would be and how they would be determined going forward. Our comments back to staff was that having that level of ambiguity could be problematic in the future, and so we felt that there would be it would be appropriate to maintain some level of specificity to regards to what those levels should be. Staff took those comments, made further revisions, and we're fully supportive of the draft that you have in front of you now.
Okay, PCA?
Christy Fields, PCA. The proposed changes to the real estate portions of the policy were all very small and cleanup in nature, so we have no issues with it and are supportive.
Makita?
Lisa Bacon, Makita Investment Group. As with the others, we had an opportunity to review a draft. We did have a few comments on that. Everything we felt strongly about was reflected in the draft that you have in front of you, and we don't have any comments besides what are in our letter. We are supportive of the changes.
Okay, thank you. We have a question, Mr. Moore.
Hi, my question has to do with the affiliate fund benchmarks. Looks like a couple of them have changed from a FTSE-based benchmark to a MSCI benchmark. What's the reason for that?
That was to align with State Street's benchmark.
Thank you.
Okay, no further questions. Thank you very much. We now will move to item 9, information agenda item, CalPERS Consultant Public Fund Universe Comparison Reports, Wilshire Associates.
Morning again, Andrew Junkin with Wilshire. I just need to find the right page. Bear with me just one moment. Oh, I can just go from this. Perfect. Problem solved. I want to start by saying this is an annual report that we provide that compares CalPERS to other large pension funds north of $10 billion. And I want to start by saying it is a very interesting data point, but its usefulness, I think, is limited, because included in this universe are some funds that are just not at all like CalPERS, right? There are some funds that are, I know, 30% funded, and they have a very different investment strategy, and they should. There are some that are 98% funded, and they also have a very different investment strategy. So it is in some ways sort of a report card of what the pension world is doing and how CalPERS slots into that. But I would not take this as a measure of success or failure. It's just another data point that you should have, but it's probably not actionable. And we've talked about it, and I'll bring it up again. I think the most obvious way that CalPERS at 360, 70 billion, depending on the day, is different than a $10 billion fund would be the ability to scale into alternatives. At a $10 billion fund, you can pretty much do anything you want when it comes to alternatives. You could be 20% private equity. That could be your target. You might not get there. There's no way CalPERS could ever do that, right? So it's just going to be different. So having said all that, I'm going to bounce around. I'm going to apologize in advance. The graphics on some of these pages are abysmal, and in some cases it's impossible to even see the little letter that represents CalPERS. This was not intended to be an eyesight test. I've zoomed in as far as I can on my iPad. I still can't make it out. So starting on page 2 here, and now I'm going to have to pull up my report because the notes that I made to myself require me to be able to zoom in, but I'm there. If you look at the 5-year return, the way this page works, the top is the graphs, the light blue band is the 5th to 95th percentile So there are some observations that are outside of the universe technically, otherwise the bars stretch to be so big as to potentially be meaningless. The blue square, in this case, is the Wilshire 5000. The green triangle is the Barclays government credit, so high-quality fixed income, and then the red T would be CalPERS. If you look at the 5-year, the 7-year, the 10-year ranking down at the bottom in the table, the number in parentheses is the ranking. So the 5-year ranking for CalPERS is in the 60th percentile. The 7-year ranking is in the 55th percentile. The 10-year ranking is in the 90th percentile. Now we know what's in that 10-year ranking that next year won't be there. Pretty significant hit in the real estate portfolio. So that's kind of the biggest difference between the 3 and the 5-year, the 5-year and the 7-year numbers. Moving on to page 4, this is 5-year risk versus return. Again, this is one of the pages where you really can't see the letter. I think it's right under the line, just a little bit to the right. So a little bit low and a little bit right, but pretty close to median in terms of risk, in terms of an absolute risk number, and pretty close to median in terms of return. As we just saw on the prior page, it's really the 60th percentile. I think page 5, which happens to be the clearest page in terms of our graphics, is also probably the most important page. And so this is actually a look, this is not returns, this is the actual asset allocation of CalPERS compared to that peer universe. And a couple of things sort of stand out right off the bat. One is alternatives, where you can see CalPERS is significantly below the peer median, sort of in the bottom quartile, again, in terms of allocation, not return. So bottom quartile just means you have a lower allocation. Now, alternatives includes private equity, but for the rest of the universe, it also includes things like hedge funds and risk parity, 2 things that you just don't have significant exposure to. That's one of the reasons why I think you're sort of as low as you are there. The other 2 things that I think jump out would be the CalPERS weight to U.S. equity, where you're in the 84th percentile, so you have less in U.S. equity than many of your peers, and the international equity weight, where you're in the 14th percentile, you have more international equity than many of your peers. This goes to the decision that was made probably 10, 11 years ago to eliminate the home country bias in the public equity portfolio and to allow the weights of U.S. and non-U.S. to be fully reflective of the global stock market. And the thinking behind that was what we really want out of this portfolio is global equity beta, an exposure to global GDP growth. Thus, why would we tilt towards the U.S. or away from the U.S. when what we really want is full global exposure? Many of your peers have not done that. Many of your U.S.-based peers continue to have a biased portfolio. They lean more heavily on the U.S. Market. The U.S. market has outperformed. I'm going to walk through a few of those pages in just a minute. So those I think are the 2 critical pages. Now I'm going to skip a few pages here and go to page 8. And again, I apologize for the size of the font, but if you zoom in and look at like the 5-year number here, CalPERS ranks in the 42nd percentile, so just above median in terms of a U.S. equity return. Pretty good. If you go to page 10 and look at that 5-year number again, it's the 35th percentile, so pretty much the top third. Again, a pretty good ranking. Now I'm going to go backwards. We're going to go to page 6, which is total public equity. And if you look at the 5-year number here, it's just below median. So how do you have an above median ranking and an above median ranking in the 2 components, but below median in the total? And again, it's that weight in the U.S. and non-U.S. equity. So I just want to make clear to everybody sort of the impact that that single decision has, which again, we, Wilshire, have taken the same stance with all of our clients. We believe that exposure to the global GDP growth, is best expressed through a global equity portfolio. Just a couple more pages, or just a few more pages. So now I'll jump to page 12, and we'll cover a little bit of of good news here. This is private equity, and I'm just going to look at the 10-year ranking because anything less than 10-year gets a little bit subjective. 40th percentile, above median, not quite to top quartile, but in my opinion, that's a pretty solid private equity peer group ranking for an investor that suffers from scale at CalPERS, and there are plenty of things that your staff is working on to address that. Page 14, the income, this is the full income asset class ranking, and the 10-year number here is not a typo, that you are the #1 fund in the peer group there. So it's been really to dovetail into the comments that were made earlier during the Global Fixed Income Review, both by staff and by Wilshire. Performance has been good. I think this proves that out. And then last, to bring it home is real estate on page 20. And really this one is, again, I've made these comments, kind of if you look at 5 years, 7 years, 10 years, the numbers are kind of all over the map. The 5-year ranking, in the 41st percentile. The 7-year ranking in the 5th percentile, so great returns for 7 years, and that 10-year number's got 1 year that we want to ignore in there. So this will be a very different report when you see it again in another year. Hopefully that 10-year return on real estate will have, the ranking will have moved up. So that's the end of that report. I'm happy to take any questions that you may have.
Okay, thank you, Andrew. Yeah, I have a question regarding your comment about the usefulness of this report because of our size. And as we continue to grow, it appears that our size is going to be even bigger than our comparison portfolios. So either do we continue to use this report if it becomes more and more less useful, or do you make changes in the report so that it does become more useful? So I don't think we're in a position where we just stay the course. So we got to do something if you're saying this report is limited in its use.
Well, I'm going to break that into my response into two parts. My belief that there's some limit in the usefulness of universe charts is true regardless of your size. You could be a $10 billion plan, and I would have given you probably the same speech. Mm-hmm. Generally, it's interesting, and I think there's data that as fiduciaries you would want to be aware of, mm-hmm. But rarely does it lead you to take action on something that you haven't already seen somewhere else, performance versus a benchmark, or in an annual program review, the identification of a trouble spot, something like that. So that's not to say clearly that's not to say you should not use this data. I think it's important that you see it and digest it, but just me handing it to you and then walking away without sort of laying the groundwork, I think is even less useful. The second part of my answer would be, we can definitely customize the universe as we start moving the cutoff up. As an example, if we were to go from 10 billion to 25 billion or 50 billion, at some point the peer universe drops to such a low number that it's no longer really even meaningful, right? It's you versus 6 funds or something like that, and we can probably list them off on our fingers. So we've tried to sort of balance what's the cutoff, but we have been at 10 billion probably for 10 years, and I think funds have grown. Certainly CalPERS has over the past 10 years. So it's probably time for us to take a look at that number and decide whether that's an appropriate number or not.
Okay, thank you. Ms. Taylor?
Yes, thank you. I just had a quick question for you, Andrew. The exposure to global GDP growth and having a non-bias, right, that we decided on, has put us behind more than a few other like funds, specifically CalPERS or STIRS, in terms of our returns. because they're weighted to the U.S. equity market. Is that something that we should consider changing to in the future?
I think that having just gone through the asset allocation process, that's the most logical time to address it. It's certainly up to the investment committee if there are other times to address it. You're right, that is a decision that has had a negative impact on returns. Could have easily gone the other way. And so...
But it's been going this way for quite some time now.
It has been, and just in thinking in terms of sort of board governance and who was on the board 10 or 11 years ago when this decision was made, I probably just need one hand and to count the number of board members. So there may be some value for you to just have a refresher on that. And I see Elizabeth has turned on her mic, which is generally my cue to stop talking. So,
I didn't mean to be impolite.
No, it's not at all.
So no, it was just to add on your excellent question. I think it's a good point at every time to rethink about our basic assumptions, and especially such one which is so crucial as whether or not we should have home bias. I would like to emphasize that this is really part of the strategic asset allocation and not of active risk per se that we take on top of that. It's really the base of the strategic asset allocation. I just wanted to bring it back in the context of that process that we have and that we are going to do. So certainly we know that the next, we are within this process, and the next mid-year review for 2020 as part of the ALM process will address that on an extensive manner. Great. And we're already starting to think about that in all our assumptions for that process.
I didn't want to go outside the process, but I thought it should be mentioned. So thank you very much.
Thank you for your point.
Ms. Hollinger?
Thank you. Appreciate this. I had a quick question. I know on the CalPERS direct model, the motivation behind that is to get us up to be able to increase our scale. But I was wondering if you compare ourselves on the private equity slide here, if we just compared ourselves to the Canadians who do direct investing, or do they basically occupy those additional, the top quadrant on private equity, because it's similar in size?
In terms of performance or the size of the allocation?
In terms of performance.
That is actually not
or you may not
that
know.
I know off the top of my head. So
okay.
The universes these are Wilshire universes, and they're compiled sort of with the agreement that Wilshire won't cherry pick individual funds. We can report to you and show you the rest of the universe, but there's some anonymity included, just like we wouldn't go to a Canadian fund and say, well, here's where CalPERS is. That's just the nature of the agreement that we have on those universes. So the answer is I don't know, but I don't know for a reason.
Okay. I appreciate that.
Okay, so seeing no further questions, thank you for that. We will move now to item 9B, corporate governance update. Voting proxy.
Great.
Share owner.
Yep.
Campaigns and corporate engagement. See, the team is coming down.
Here we go.
The Beth team.
Great. I'm gonna get us started here, Mr. Chair. I'm just flipping to a page while we let Samiso and Beth join us.
Okay.
As I mentioned in my opening remarks, and as you just alluded to, this item is a corporate governance update on proxy voting, share owner campaigns, and corporate engagement, which is a subset of our overall ESG strategic plan. So that's why I thought I'd start with the overall plan first, just to ground everybody in what this subset is. So if you look at our overall 5-year plan, and you go to the very bottom right-hand corner, you'll see proxy voting, share owner campaigns, and focus list. So we'll be covering that today. In the middle of the chart, you'll see diversity and inclusion, and 2 dashes on engagement and voting. So we'll be addressing that today. And then if you turn to the left on Engage 100 plus on the PRI Montreal Pledge companies, what we now call our Climate Action 100 plus, we'll have an update on that today. So that's just to give a little bit of a setting. We have a lot of activities on ESG overall. A strategic plan, the Sustainable Investments team is responsible for our overarching overall strategy across all of our asset classes, number one. And then number two, in March, we come back to the committee for a full discussion on our overall plan and all of the constituent parts, as well as a review of our actual proxy voting principles, our global governance principles at that time. Today's discussion is meant to focus on the proxy season. Specifically, we now have, Samiso was telling me yesterday, about 9,200 votes have been cast out of what we anticipate to be about 11,000 for the full season. So to review how the season went, kind of give a report card on the activities, how in general the 9,000 votes went. That's a very big task to try and summarize how 9,000 votes went, so number one. Number two, to focus in on the priorities that we've identified for the global equity proxy voting season. We had a session in March and April together to identify what would be our priority subject matter areas. So in March and April, we identified corporate board diversity, climate action, and executive compensation as areas of priority, with a continuing emphasis across the board on proxy access and majority vote. So that is the setting for the presentation today. This is the overall report. And this is the overall 5-year strategy, which we'll come back to in March. Today is a review within our global equity program, how the proxy season, share owner campaigns, and engagements went with our public companies as we anticipated in March and April when we were going into the proxy season. And with that, I will turn it over to Samiso to go through the report card, and then both together, Samiso and Beth, to give a glimpse of looking forward for the coming year, and an opportunity for the committee to give us feedback on how the year did and things to think about as we bring back our strategy and our areas of emphasis and priorities for next March. In short, we think it was a successful season. I think when you review the numbers across the board, lots of achievements, lots of improvements across the board, particularly on the priorities that we have. I think the metrics are showing movement overall on the areas that we care about. But there's room for enhancement for sure, and further success next year, and that's what we want to spend some time talking about that as well. So with that, Samiso, I'll turn it over to you and Beth.
Thank you, Ted. Members of the Investment Committee, good afternoon. My name is Samiso Nzima, Investment Director, Global Equities. Before I get into the actual presentation, I just want to take this opportunity to recognize the corporate governance team and the work that they put in, over the years, and especially this season. The board gets to see me 3 or 4 or 5 times per year, but you don't really get to see members of the team. But I just wanted to recognize them for the hard work and the success that this program is achieving. I have Todd Matley and Craig Rhines behind me, but also have Stuart Hall and Tamra Sells back in the office, manning the shop, so as to say. But really, getting back into the presentation, we have 30 slides prepared. I'm not going to go through all these slides. I want to focus really on the two slides which look at the 2018 processes and outcomes, as well as looking ahead, so the 2019 processes and outlook. The summary of contents really shows the statistics related to these two slides that I'll focus on. And then in the appendix, we have the entire body of work that the corporate governance team was involved with in 2018. And, you know, at the end of the presentation, I'll be open to dialogue with the board and take any questions related to the entire presentation, not only on focusing on the two slides. So looking back, the 2018 processes and outcomes, what is it that we achieved, and what were the things that we're focused on? I'll start with corporate board diversity, which is the first two bullet points. And really, you know, with corporate board diversity, we're on a journey and we were making progress. 30% of the companies that we engaged starting in July last year have added a diverse director to their board. That is 151 companies out of the 504 companies that we engaged last year. So that's really something which we are seeing movement in that area. But I want to emphasize that really the work we are doing here is like trying to boil the ocean. You know, it doesn't happen overnight. It will take time, but we are determined that with the ownership rights that we have, we will move, you know, the market and get this to move along. Speaking of ownership rights, we actively used our ownership rights in terms of holding directors accountable for improving corporate board diversity. As a result, we voted against 438 directors, 841 companies, where these engagements did not have constructive outcomes. And just as a point of emphasis, really here we're voting against board chairs, members of the nominating and governance committee, as well as long-tenured directors. Again, because we think this matters. It matters for the bottom line. It matters for the returns that we get. This is what really pays our pension in terms of the returns that we get and companies being managed effectively. Shifting gears and looking at executive compensation, in March, we came to the board and talked about the enhancement that we did to the voting practice on executive compensation. And as a result, this year, we voted against 43% of say-on-pay plans, which is the executive compensation proposals. And this compares to about 16% over a 5-year average. So this is a significant change in terms of voting on executive compensation, and we're hearing from other investors and you know, talking about this and what we're actually doing in this space. So we're going to continue to hold companies accountable for performance. We think that executive compensation should be cost effective and also show a direct and non-complex link to shareholder value creation. Last but not least on this, really, the share owner campaigns that we engaged in. These companies were identified either internally or in partnership with some of our strategic partners. And we targeted 121 companies, which resulted in 88 settlements. We still have about 16 ongoing engagements, and we ran solicitations at 17 companies. The results of those solicitations are at in the appendix on slide 29, so I won't go into that here. But really, this is what I wanted to highlight in terms of the outcome of the 2018 proxy season. Looking ahead, looking at the 2019 proxy season, this is really an area where there is a significant collaboration between, you know, ourselves, corporate governance, global equity team, and sustainable investments. And our goal here is to make sure that we sync the corporate governance work that we do with this ESG strategic plan to make sure that really we are touching on those priorities that are identified and which we come and report to the board in March. So we'll continue to work collaboratively with the Sustainable Investments team in terms of looking at strategies that we could implement and enhance. And then also in the review of the global governance and sustainable investments principles. So here what I have really, I listed some of the a subset of some of the issues, activities that we'll be looking at, but I'm not going to go through these. I'll have Beth sort of talk through some of the high-level thoughts that we have, especially on corporate board diversity, as well as on Climate Action 100. Over to Beth.
Thank you, Sumiso. Good afternoon. Beth Richtman, CalPERS staff. So after the great discussion we had at the board offsite, the SI team and the corporate governance team thought about what we're doing on diversity and inclusion related to our public companies. And we concluded that really we don't want to just be looking at diversity at the board level. Conveniently, in the United States, there's a reporting standard which requires all companies with 100 or more employees to file a report by law on an annual basis that reports on the company's gender, race, and ethnic data on key positions and overall workforce. It's actually a report called the EEO-1 that's grounded in the Civil Rights Act of 1964, and it's a report our US companies are already doing. We just want them to make it public. In fact, right now, well, as of 2017, the data we have, only 3.2% of Fortune 500 companies are actually reporting this data. But some of the issues that create the sort of scarcity of diverse boards that we've been talking about come in part because of maybe the overall workforce. And so we'd like to understand this better. I should note that the data won't tell us about every element that CalPERS cares about related to diversity, but it will tell us a lot. And it will allow us to compare companies within industries and across the United States. And importantly, it will allow us to assess how reflective a board's diversity is of its workforce. As Ted mentioned, we'll be coming back in March to discuss potential updates to the ESG strategic plan. One thing I'll note related to this and related to diversity and inclusion is that we do intend to take a broader approach to D&I. Currently, in the ESG strategic plan, it's really focused on our public companies, but we are working on a total fund approach, and we look forward to coming back on that. And additionally, after the board offsite and some updates to the governance sustainability principles that you adopted in June, there are a couple of things that we'll probably be adding to this strategy that I wanted to mention, and one is on harassment, and particularly sexual harassment, and two is related to looking at compensation, particularly inappropriate pay gaps related to gender and minorities. So that will be new elements that we'll be thinking about as we're working on our strategy. So I look forward to your further thoughts and questions on these issues and appreciate your past comments. The next thing I wanted to cover briefly is Climate Action 100+. You know, it's funny, the numbers in this presentation just prepared, I guess, a few weeks ago are already stale, in that now the initiative has 296 investors and over 31 trillion of assets behind it. Climate Action 100+ has been recognized by the global media as the world's largest and most ambitious investor engagement project. The investment office is quite proud of the key role that CalPERS has played in building this initiative into the force that it now is. And I want to recognize all the great work of Ann Simpson, who's the chair of the Initiative Steering Committee, but also the other 5 members from corporate governance and also the Sustainable Investments team who've been working really hard on getting this off the ground. You know, that's a significant amount of resources going into this initiative from our team, but I will mention that our holdings in the companies in the Climate Action 100 list aggregate to over 20 billion. So this is a very significant initiative for us for a reason. And also, the systemic risk to our portfolio of climate change grows, as we know, every year. There will be an annual benchmarking of the progress with the companies as part of the Climate Action 100 initiative, which will help inform our shareowner engagement and how, you know, our proxy voting team will be exercising votes at future company meetings. The first report in the benchmarking analysis will be published in early 2019, and we look forward to sharing those results. Now back to Sumiso.
So at this point, really would take questions from the board and any dialogue and direction that you may have for us.
Okay, thank you. Ms. Brown.
Thank you. I wanted to go back to the 2018 Proxy season outcomes. The first bullet, you talked about that 30% of the companies you engaged with added a diverse director, 151. So do those companies have none before and now they have more than one or more than one, or did they, I'm just curious.
They've added an element of diversity that they did not have. So they may have had some elements, but not, as we look at our definition of diversity, is really broad-based. So it's an element of diversity that they previously did not have.
So they may have had a woman on the board, but maybe not an African-American male or something like that. Is that correct?
Yes.
Okay, so these aren't brand new to diversity. These are just increasing the amount of diversity potentially.
Some of them may not actually have had any diversity.
So I'd like to know what that is, which ones that didn't have any and the ones that now have increased. Because I think it's great if we go from none to some as opposed to some to more. My next question, where you talked about you voted against 438 directors. So how many of those were actually ousted, did not make it back? I know we said we voted against 438. Did any of them not get put back on the board?
We'll have to go back and look at that. But in terms of our holding in these companies, we don't hold enough shares in terms of actually getting a director being, having to leave the board. Some of those companies actually have majority voting. So if for example, if the directors had received less than majority support, then they would have had to resign from those boards. However, I just want to emphasize that the fact that we may not have significant holdings, it's not it's not a handicap. There are a number of companies which we had written before, we'd written the first letter and the second letter on this issue, and which they never responded to us. But when we voted against the directors and wrote to them and explained why we're voting against the board chair and the nominating and governance committee, they actually reached back to us at that point after that, having that against vote coming from us, even though we actually hold a small percentage of the overall float of the company.
So because you voted no, you got them to engage because they don't like being
engage.
told no.
Exactly.
Okay. It'd be helpful to know which of those did re-engage after we voted no on them, and those that just sort of said we don't care and turned their back. That'd be nice to know as well. And then the last one was with pay, and I don't know how successful we were with any of these, where we said we voted against 43% of executive compensation proposals, and my guess is, all the CEOs got their money, but let's let you tell me what the answer was.
Yeah, so the executive compensation proposals, those are advisory votes, and
Right.
at the end of the day, if the company they'll pay the CEOs. But I think what this reflects and what this encourages, it leads to more engagement with the companies. We're already hearing from some of the companies that we voted against, where they're reaching out and saying, what is it that we need to do? Why did you vote against? So at least it's a start of engagement in terms of, in terms of executive compensation. And we'll engage these companies and see what the problem is, whether the problem is with the design of their comp plans in terms of the failure to link, the pay to performance of the company.
Great, thank you.
Mr. Costigan?
Great, thank you. Mr. Jones, great report. Just a few questions I know that I asked last year, and I think Ms. Simpson, as part of this report, had talked about majority voting and all. And I don't need an answer now, but I'd like something back. So last year I raised the issue of Apple and BlackRock. And so when we talk about voting against people and voting for board diversity, one of the things I pointed out was the lack of diversity on Apple's board of directors, and that one of the female board of directors at Apple was the head of the nomination and governance committee at BlackRock. And when you cross-reference those two, there is clearly a lack of diversity on both boards, and when that same individual sits on two large boards of which we have majority shareholder voting, so all the parameters that we want were in place. So I'd like to know, again, a question I had raised last year, where are we voting where we have that authority against directors that serve on multiple boards? I think, as we've raised before, I think Ms. Brown raised this as well, is we've talked about geographic diversity, educational diversity, gender diversity, LGBTQ, race, name all of it. So again, this was a question I raised. You can go back, look at the transcripts. Last year I raised this at Apple, and I also raised it as related to one of the large banks because there was an individual that sat on multiple boards. And if we talk about board diversity, as we've talked before, there are 25,000 board slots. Board diversity means adding more people, not the same person to those slots. So I don't know what we did with Apple or BlackRock.
I can't answer the specific companies, but in terms of the people sitting on multiple boards, the governance and sustainability principles, we actually have that taken care of, and it's part of our voting practice. So if you're a company executive and sit on one other board besides where you're a company executive, then we actually vote, we vote against you.
So then on that one individual who's on Apple and BlackRock's board, I'd like to know how we voted her.
We can check that and
so
come
just,
back
again,
to-
these are great reports. Look, I know, and then just in some specific areas, you guys do amazing work, so I really appreciate. So I'm just asking some probing questions. And I'm not picking on any company here. I'm just looking at on slide 29, 502 of 503 of the iPad. I just picked one at random. MGE Energy. I just want to make sure that I understand how this operates. They had a climate risk proposal. Do you want to get slide 29? Okay. Had a 10%, which means it failed, but only 10%. We only garnered 10% in support. So the question I have, and you can get back to us, is 10% of what? So how many eligible votes were they? And I think you actually touched on this, which oftentimes we're operating against a board of directors and a chair and others. So if there are 100% of the voters in the universe, okay, how many actually cast a vote? So was it 70, 80, 60, 40, 30? Okay, so it's 10% of what? Because it's a little bit, it failed, but if it's 10% of 30%, right, we can start putting votes together. The other question is, I know we go out and solicit, as you made an excellent point. We may not own a lot, but we have a big voice, so we go out and gather others. I'd just be interested in a case study on one of these that failed. Did they go out, in fact, solicit the other way? So again, I'd like to know, and I pick anyone you want. I just picked them because it was a climate change. Notice it was 10%, kind of a round number. But again, what's the universe? How many cast vote? Because if you have 30 or 40% of shareholders that are disinterested, why is that? And then just a generic question. So we voted against Elon Musk. And again, this is something we can talk about later date, but I do have concerns when the CEO of a company goes on a public broadcast and engages in activity that really should be a terminable offense. And I saw that we voted against his compensation. I don't know if you want to expand on that, but we didn't raise any other issues, or I'm trying to get the timing, or did that incident occur after the proxy voting? Because I'm curious as to how we dealt with what he did on the radio show.
So since our engagements with companies are private and confidential, we can take this to the closed session and expand
That's
on
fine
that.
then. We can talk it then. Thank you. Thank you, Mr. Chair.
Okay, thank you. Okay. Ms. Marther?
Thank you very much. Well, I have to say I'm very encouraged by the progress we've made, both in terms of the diversity component, which we know is demonstrated to deliver additional value. We know that diversity on corporate boards means that company is likely to be more successful and to deliver better performance. And so the fact that we're making significant progress there, to me, is incredibly encouraging. And Climate Action 100 Plus, where again, we know that climate change is a real material risk to companies and to CalPERS portfolio performance, the fact that we're not alone, that hundreds of large institutional investors agree and have brought almost, over $30 trillion of assets behind this initiative because they see it as not just an existential threat to us as a society, but really as a truly material investor risk, is quite stunning, and I think far surpasses where we thought we would be just a year ago. So I'm really proud of the work that CalPERS and all of our partners in both of these undertakings have made over the past year. I do have a couple of questions, or first another comment. With respect to the diversity initiative, as I recall, the 504 companies that we sent a letter to had no women on their boards. We use that as a proxy for other diversity. So it would not be true that they might have a woman on the board and we're adding another element of diversity. It's really that we know that there's no gender diversity. There may be other types of diversity reflected on the boards that's hard to capture given current data. Is that an accurate statement?
That is an accurate statement. The criteria that we use for those 504 was gender diversity in terms of, because that's what was publicly available.
Right.
But as we then engage with these companies, we then talk about some of the elements of diversity besides women. So technically, yes, that's true in terms of that they wouldn't have had a woman on the board.
Right, so it's possible there's some other element of diversity that's not currently captured by the data that's reported, but nonetheless, they are now adding a diverse director. 151 of those companies are adding a diverse director. I think that's quite a lot of progress over 1 year. I know that this is only the first step in a series of work that we're going to do, but I think it's an important move forward. I also wanted to ask, I'm also very encouraged by how we've been voting on the executive comp proposals. You know, one of the things that I think we have seen in the public markets is the life of a company has shrunk quite considerably. I think it's a couple decades ago, it was something like 60 some odd years that a company survived, and today it's more like 17. And that is quite astonishing. And also CEO tenures have reduced. For now, I think your average CEO doesn't lead a company longer than 5 years. So ensuring that there is alignment between the CEOs and the long-term performance of a company, which obviously impacts the performance, the performance of that company and our own performance of our portfolio, is essential. So while focusing on, obviously the executive compensation proposals are quite complex. They involve lots of different elements. But I want to, I guess my question really is, how are we thinking about longevity of these companies and sort of the life cycle of these companies? Since we're going to own these companies through their life cycle, we are largely passively invested in the public markets. Pause there for an answer.
That is an excellent question. And really it gets to the core in terms of our engagement with these companies. When we look at executive compensation, we tend to be CEO agnostic. Really, what we are evaluating is that the structure of the compensation is really set up that this company is being managed for long-term sustainable value creation, because we're going to be owning these companies forever. We really own, it's not owning a stock, we own a business, essentially. So the CEO may change, but even with CEO changing, we want to ensure that the design of the plan is focused on long-term strategy, and that strategy thinks about the sustainability of value creation. So really it's an excellent point. We realize the tenure of the CEO is getting shorter and shorter. That's why really our focus is, regardless of who's sitting on that chair, we want to make sure that the compensation committee, and that is why we're voting, we're looking at voting against the compensation committee members, again, in terms of looking at this area, because they are responsible for the design of the comp plan, and that design should be aligned with companies' long-term business strategy.
Yes, and of course, we don't want to see CEOs extracting significant, share owner value out of, for their own benefit in a relatively short period of time, when that's really needed to advance the future performance of that company. So I appreciate that that's the focus. That is absolutely, that's consistent with our investment beliefs. I think that's consistent with our own sort of long-term horizon. So thanks for the good work.
Thank you.
Ms. Taylor?
Yes, thank you, Mr. Chair. I just want to thank you, Beth and Samiso, for the report. Very comprehensive. And I saw some new stuff that I hadn't seen before. So I like the fact that we are using the EEO1 data. We didn't really have a measurement before, so I congratulate you on requesting companies to include that. How are we doing with that? Are companies actually including their EEO1 data as we requested?
Thank you for the question, Ms. Taylor. So that is part of what we're going to be focused on going forward. This is a new element.
It's a new element, okay.
Yes. So right now, it's about 3.2% of Fortune 500 companies report. So there's a big gap there.
Oh, yeah.
And that is something that when we come back in March, we'll actually have some goals around what our targets are and the approach. But that is a new enhancement to for our D&I strategy for public companies to get beyond just looking at board diversity.
Great. So, is there a plan, just as a thought, is there a plan to partner with some other like organizations to help push that through for more than 3%?
Yeah, absolutely. And there have been organizations that have been putting forward proposals over time, and some of them are getting very close to passing, or getting in the 40%. And so we've already started talking to some, but with many things that we're trying to achieve, we can't do it alone. And so strong partnerships make a lot of sense for us on trying to achieve our objectives such as this.
Right, and it's so apparent when it works so well for us in the Climate 100. So I just want to make sure that we're hoping to get there through other means rather than just by ourselves.
Yes,
so I appreciate all your hard work. Thank you.
Thank you.
Ms. Yee?
Thank you, Mr. Chairman. And again, thank you for the report. I wanted to just ask a question that was highlighted on slide 7, and it showed that there had been there's a market decline in support for global management proposals and increasing support for global shareholder proposals. And just want to get your thoughts on why you think that is, and whether that's a trend that will be continuing.
Yeah, in terms of, again, thank you for the question. In terms of the decrease in support for management proposals, again, it's about us holding companies accountable for long-term value creation. Part of that, really, if you look at the significant drop there, which happened in 2017, was with the Japanese, companies who were pushing for board independence in Japan. A lot of companies in Japan really do not have majority independent boards. In fact, the Japanese Corporate Governance Code and the Company Act only calls for 2 directors in terms of being independent. So since 2017, really, we have been working on this and trying to push companies in Japan to move their board diversity to at least initially 1/3, and then eventually to move to majority board independence. So a significant, reason for that is that, and we'll see this actually, moving forward, increasing in terms of. Not increasing and becoming lower and lower again as we vote against comp plans, as we vote against compensation committee members and so forth. In terms of the support for shareowner proposals, I think our view really is that everything we do is grounded in the governance and sustainability principles, and if shareowner proposals are aligned with our view of the world, we'll support them. And we're seeing an increase in the sophistication and especially on international markets, where shareowner proposals are getting written in a much, much better way than they were, in the couple of years ago. So that's why we're seeing an increase in support for those.
That makes sense. Thank you. And I had a couple of questions regarding compensation. So I like the 43% in terms of the executive comp proposals that we opposed. Were we joined by a majority of other shareholders in opposing more of the say on pay questions this year?
We don't have the data for everyone right now. So what we have, we looked at data, I think it was end of August, and looking at global investors that voted on at least 1,000 say on pay proposals that had already filed their NPX filings, so that became public record. Only 48 global investors, had voted on more than 1,000 say on pay proposals. Of those, our 43% against vote actually is the 5th highest of the 48 global investors that had. And if you look at those, the top 8, in fact, there are only 8 investors that voted against at least 20 20% of these proposals. And the average for those is about 46%. So we're close to the average in terms of the top investors that voted against say on pay. We will see it. We'll come back in March and with the full set of data to see where others are. But I think the fact that we are doing this, and CalPERS is known for leadership in terms of governance. And we've received a lot of publicity in terms of our votes against executive compensation. We think that will actually help with other investors look at this again.
Yeah, okay. And then can you give us a flavor of how much the executive pay ratio factored into our analysis of executive comp?
Yeah, so this is the first year that the CEO pay ratio is being reported, and so at the beginning of the year, we took a decision that since this is the first year, really we didn't have sort of enough data. So, for example, the first company that reports is the only company that would have reported, so you don't have sort of a benchmark in terms of looking at it versus its industry and versus everyone else. So it really didn't make sense for us to start incorporating that right away. We were looking at it when we're looking at executive compensation in terms of if the plan seemed like it wasn't aligned and the CEO pay ratio seemed like really out of whack, really, really high, then would take that into account. But it wasn't really from a benchmarking perspective because we didn't have a full set of companies that have actually reported this. And once this proxy season is over, we'll have a full set and we'll take a look into that. And our understanding again is that even the proxy advisory firms did not take that into account this proxy season.
Okay. So more to come on that.
Yeah, definitely.
Okay, good. And then lastly, can you provide an update? I'm not sure that I heard anything recently about the SEC's review of proxy access advisors and kind of that whole, whether we're weighing in on that whole discussion or not.
Okay. In terms of where we are right now, I think we actually weigh in terms of the comments. So there's a comment period and everything, and I think we did through the governance and sustainability subcommittee. We have a correspondence working group where we do comment letters and so forth. And we understand this is still something that is still ongoing. I think there's going to be a meeting sometime, I think within the next 2 months or so, looking at that. And our view again is that proxy advisors, they provide some recommendations and analysis, but they're not, they don't determine how we cast our vote. They help us in terms of sort of looking at some of the issues that are out there and really they help us focus on things faster, but they're not really the determinant of how we cast our votes. And that's something which we'll sort of will communicate. I think we still have Ann Simpson on the Investor Advisory Council of the SEC, so we'll communicate that through that process.
Okay. I guess could I just ask that we could maybe get some updates on that as there continues to be kind of things emerging around that? I mean, it really is kind of an issue with respect to just the third-party proxy voting services and the issue of independence. And so to the extent there's activity there, we can get an update on that.
Yes, we include that. Okay. Thank you.
Thank you.
Yeah, I have a couple of questions. On the EEO-1 issue, while the government set forth some standards for reporting, first question is, are there any consequences of not reporting by these companies?
It's my understanding that it's the law, so I could find out if there are fines or consequences, but it's my understanding that it's sort of a requirement for companies that have more than 100 people.
Okay, and so the compliance issue, and whether or not there are any aspirational goals in this provision, in this law, in terms of what they're looking to, what kind of goals they're seeking to obtain?
Well, for the law,
yeah.
Or for our project?
Within the law.
Within the law. That's a good question. I know that it's a reporting requirement, but I'll have to look to see if there's...
Okay, thanks. No, and then Next question is our 3D. You mentioned that the additional members on corporate boards. Do you have any information to determine how many of those came from our 3D database?
I don't have the information right now, but we can actually go back and look at that.
Yeah.
I think at the board offsite in July, I think Belen from Equila did mention that I think this year we've had about 90 members coming out of 3D going on public boards, but in terms of the ones that I'm talking about here, I don't have the information, but we can get back.
Yeah, it'd be helpful to know because, we spent a lot of time and effort to create that database along with CalSTRS, and we were responding to corporations that indicated they can't find qualified candidates, and all of a sudden we gave them 400 people that are qualified, and then they said they don't have any openings. So I would like to know how that's being achieved. The next question I had is several years ago we created our diversity forum for CalPERS. And I think the date for having another one has been slipping, and I hope we got a date now so that we can start publishing when we're going to have our CalPERS Diversity Forum. I see
Carrie, Carrie Douglas Fong, who's been working on this, is coming up, and but it's been really challenging to find a venue, but thanks to some heroic efforts of staff members, we do have June. I guess June 2019 is the date, and we do have a venue in Sacramento. Okay. I don't know if Carrie wants to add anything.
Good afternoon, Carrie Douglas Fong, Associate Investment Manager. The Sacramento Convention Center will be closed for about 18 or more months, including this next year. We've managed to find an alternate location in Sacramento at the Sheraton, and it'll be hosted the June 10th and 11th. So that is the date, and I think that's as of last week.
Thank you very much. I appreciate that because when I'm out and among our partners, they always ask that question, when is the next CalPERS Diversity? Because it was a highly popular event and people really did enjoy participating in that event. Okay, that's my questions. Seeing no further questions, any other comments, Beth or Samiso? Okay. On that, we have a public request to speak on this item from the public. Michael Ring.
Chair Jones, members of the committee, long time no see. Michael Ring with Service Employees International Union. On behalf of our members, thousands of whom are CalPERS participants, just a couple of quick points. One, I think we just want to thank you for your commitment, this committee's commitment, your staff's commitment, this organization's commitment to corporate governance and leadership. You all may recall that about 10 years ago at this time, we were all pretty nervous because we were entering into the beginning of the Great Recession. And I think we all know, if we look back, that one of the triggers of the Great Recession was a tremendous failure among corporate leadership, both at individual companies, at the regulatory level, and at the systemic level. So this work is actually, in many people's view, the most critical work of this committee because it protects us from what triggered a massive loss in funding for CalPERS. And what is the biggest risk to paying benefits would be another systemic loss. So I just, a couple of things there. Just want to thank you for your commitment to this work, to your staff's innovation and leadership in this work. And then specifically, as you all know, SEIU is very committed to the work on diversity and inclusion in this area, sees it as a major place of risk for people who are not taking it seriously and not taking leadership, and a major place of opportunity, as the McKinsey study and others have shown, for people who are taking leadership. So I want to thank you for your leadership in that area. Thank you so much.
Okay, thank you, Mr. Ring. Okay, so that brings us to summary of committee direction. Mr. Eliopoulos.
All right, you're really challenging me this time on this one, so give me some assistance and help if I missed any or mischaracterized it in any way.
Okay.
Let's see. First off, it was a direction that was already given, but it was re-emphasized on looking to combine all the divestment items into one item, in particular the 5-year reviews.
Yes.
And we will do that. Number 2, during the Iran-Sudan, there was direction to review the vote, the decision by staff with respect to NG and the rationale for concluding that, and come back to the committee with that response. Okay. During our policy review, there was a suggestion, and I think it was directed to make a one-word change on the policy, and we are going to move forward with that in the leverage table.
Yeah. That's good.
Next, during the Wilshire review item on the universe of other funds, Mr. Jones requested Wilshire to look at the $10 billion fund size as their methodology, and so direction to Wilshire to follow up on that. Now getting to the proxy voting item that just concluded, there were a number of requests for follow-up. I'll go through them. I didn't hear a specific board direction, but I saw some nodding heads, so let me just go through what was requested, and you can confirm for us. First, with respect to the looking back at the 2018 proxy season outcomes, there was a request to follow up on specifically, how many companies added a diverse director. Well, actually, let me pause. I think there are three requests. So let me so on that one, the first one was a request to on the 30% of companies that added a diverse director to their boards. Splitting that, bringing back information, splitting that out in terms of those that went from none to at least one, and then which ones went from, at least one or some to more. And so that is one request. Next, a request of the 438 directors at 141 companies, which we did not receive a constructive outcome. As a result of the vote, were any of those directors actually ousted or not elected to the board? And then, in addition to that, which companies re-engaged with us after the no vote? And the flip side of that coin, which companies did not even re-engage with us after that? So that was one series of requests for feedback on that. In addition, a request for feedback on how we actually voted at Apple and BlackRock with respect to their boards of directors. Number 2, and I think actually Samiso answered this, was just a question of how we voted on, members that sit on multiple boards. So I don't think there is a follow-up item on that one. Right. We voted according to our principles. Right. But there was a request, as an example, the MGE Energy vote of where we were only able to garner 10% of the vote. There was a question out of how many votes of the universe cast, and we can bring that back as an example.
Okay.
Next, there was a request for an update on our engagement or our work on third-party proxy services, and particularly SEC's review of that topic of their independence and conflicts. Last, with respect to the EEO1 reporting, a request for the federal law if there's objectives that are stated in addition to the reporting requirement.
Okay.
And last from that is, the last request is a report back on our 3D database and how many successful candidates from the 3D database were added. And we have the answer. The answer is 19.
Out of 400?
Yes.
So
19
still a
are
little,
from-
yeah.
19 are from the 3D
Right.
database that were added to the board.
And is 400 the current number of that database? Total numbers?
I thought it was higher than that. I think it was higher than that.
It's okay.
But we'll follow up. Why don't we just follow up with this
Okay,
item?
okay.
How many were voted and how many do we have
Yeah,
in our
okay,
database
okay,
today?
Thank you. Okay.
I have an additional one.
Okay.
Just an additional one on thinking about how long-term strategies in companies and how it links together with the CEO tenure, and to have some statistics and to kind of think about that for our different programs.
Okay. Great job.
Thank you.
You had some I didn't have.
And we'll try and make it very specific for the minutes
Right.
that you'll see on Wednesday.
Okay, well, thank you very much. Okay, so that then brings us to the last item on the agenda, public comment. And I have a request to speak from the public. The first person is Dr. George Deere. And each of you will, and this next two people, Terry Brennan and Christy Boma, if you'll come forward and occupy these seats here, you'll have 3 minutes to speak. And the timer is here to gauge your comments. And
Thank you, Mr. Chair and members of the board. My name is George Deere, Emeritus Professor at California State University, San Marcos. I'm a retired member of CalPERS and I was a former board member from 2003 to 2014. My comments here concern the hiring of the now CEO, Ms. Frost. The key issue, I believe, in her hiring was her misrepresentation of her education, a myth that seemed to be perpetuated over some time, that she was pursuing a program at Evergreen State College that would lead to both a bachelor's and master's degree. Such a program apparently doesn't exist. So it may have been her goal, I think, as she stated, but it's difficult to call it a pursuit since she started 2 writing courses, but completed neither one, and as she was never enrolled in a degree program. Ms. Frost originated this myth many years ago and repeated the claim on her application to CalPERS. Claim was posted online by CalPERS, and I believe some members of the board repeated that myth to their constituents. Even after she was hired, nothing was done until very recently to correct documents that were posted, the press release that continued to state she was pursuing the degree. So it seems reasonable, at least as an outsider, that with not having a degree, that the pursuit of such a degree, a bachelor's and master's combined, could very well have been important in the decision to make her hire her, and if it had not been, if it had been completely upfront about what that was, a different decision might have been made. Criticism has been labeled at the original source of information about her. About the misrepresentations, the Naked Capitalism blog, which is characterized as fake news, and I certainly agree that a lot of things there are, if not fake, they're certainly exaggerated. But a lot of the key issues were substantiated by Bloomberg and others, and on Sunday, Michael Hiltzig, Pulitzer Prize-winning LA Times journalist, posted an article, Pension Fund CEOs Murky Hiring. One of my colleagues put it, ignore Hiltzig at your risk. I believe that this issue needs to be addressed. It can't be just ignored. And I believe that it's essential that a thorough investigation be conducted, and I believe best conducted by an independent external organization, and not by the board, which is so heavily invested in this. That investigation do a couple of other things. It should determine why a bachelor's degree was not required, which is very common for most CEO searches for pension funds, and also given the problem with earlier search for the CFO. There needs to be study of how to improve the process so the.
Thank you for your comments. Mr. Brennan?
Good afternoon now, I guess. Mr. Chairman, members, Terry Brennan on behalf of SEIU California. We have a different, if not opposite, take on the hiring of Ms. Frost. And I'm a little disturbed that a former union member would come up here and suggest that a blog is sufficient to initiate an investigation outside the proper rights of any employee to due process. We feel like this is rightfully something that should be handled by the Performance and Compensation Committee, which is formed to look at these sorts of personnel matters. The fact that it's been dredged out into the public, not corroborated, but repeated by other news sources, we find very disturbing. And I mean, no offense to my, dreadlock wearing friends at Evergreen College, but I can't imagine anything that would prepare you to be the CEO of CalPERS more than the experience of the CAO you've hired and the work record she's had since she's been here. Thank you very much for your time.
Ms. Palmer?
Mr. Chair, members of the committee, Christy Balma here on behalf of the California Professional Firefighters. I actually would just like to embrace the sentiments of my colleague, Mr. Brennan, who just spoke on the merits, and just suggest that, again, experience does matter. And I have watched this board and this body and this system tack at a degree we've not seen out of such an organization in recent years. And it takes some strong leadership and expertise to do that sort of thing. So I would encourage you to engage under your normal process and the appropriate committee to handle an HR problem as you would, and as my members would expect their managers to do so at a fire department anywhere in California. So I express strong support for this leader and this board in making an appropriate decision on how to handle this issue. Thank you.
Okay, thank you. That completes the list that I have.
May I just briefly respond to one of his comments?
Would you come up to the mic and state your name, the organization that you represent, and and you'll have 3 minutes.
Thank you very much, Mr. Chairman. My name is David Soares. I'm a retiree. I was a prosecutor in Santa Clara County for 32 years. I'm active in RPEA. I'm actually on the legislative committee, but I'm speaking as an individual today. And I'm just very concerned about some of the comments that I've heard, because Mr. Hilsig's article in the Los Angeles Times about CEO Frost is based on documents that were obtained pursuant to the Public Records Act. And I know members of this board thought that Ms. Frost had completed substantial coursework toward a degree. I don't think we're talking about credentials. What we're talking about is doing any work at all. And I'm concerned when we talk about experience of the CEO. Washington State, where I actually own property, my kids live, is divided into 3. It's not like CalPERS. Ms. Frost was $139,000 a year head of the clerical division that basically processes the checks, that answers member phone calls. There's an investment division, the Washington State Investment Bureau, that's actually headed by a very highly qualified woman who's been there since 2003, and I think we're really disrespecting her if we put Ms. Frost's experience in a mainly clerical job, and she has said she was a clerk typist when she was hired. She doesn't have the educational background, she doesn't have the investment experience. And I should also add that Washington has a separate state actuary who's employed by the state legislature in Washington, who does all the actuarial work. And the most important role, and why I came here to the investment committee, is of course investments. as much as I'm concerned about contribution rates, I'm also concerned about the sustainability of my pension. As a recent retiree, I have a fairly long life expectancy, and I want that money to be here. And if this board is so careless as to look the other way when there are falsehoods that have been made about someone's background to get on the board, and I think this board was misled. I don't think this board was out to hire someone unqualified. I think that you do, as fiduciaries, have to conduct, as prudent persons, an independent investigation of this state of affairs and make a formal decision about how you're going to proceed, and not just try and brush this off. Because this isn't just some blogger. I've seen the documents that were obtained pursuant to the Public Records Act, and they're very disturbing, and I think that's why the Los Angeles Times and Bloomberg are picking up this story, and it's my understanding that other very substantial media outlets are going to be reporting this. Thank you very much for the opportunity to address the board.
This meeting is adjourned, and we will convene in closed session at 2 o'clock.